And welcome out to Tackle Trading's halftime report, a daily look at the stock and options markets and everything's going on around the financial markets. Tim Justice here with my brother Matt Justice. Matt, how are you doing today?
Tim, doing not as good as gold.
Give me a quick drop of your video and bring it back up. We got that blue purple line of death. We're going to bring that
every now and then. YouTube likes to do that, don't they?
Yeah, and good morning to all of our halftime crew who already popped in here. Good to have you. Yeah, gold is doing great. The markets are doing great. The market's rallying here today on the news. Really not a lot going on. The Trump, China-U.S. talks over tariffs didn't really come to any kind of resolution or anything like that. You have the testimony from Jerome Powell there in Jackson Hole, Wyoming. I'm sure that speech was written months over the last couple of months, right, by a whole team of academics and whatnot.
Oh, I'm sure he had an entire staff preparing that speech. I didn't listen to the speech, but I read the entire speech and obviously all the takes on it and whatnot. It was interesting to see kind of the price movement. Tim, it is so difficult to understand Fed speak. It is so difficult. I read that speech today, and I don't know how many words it is. Let me see. Obviously, it was 3,463 words. That's how many words it was. And of those 3,463 words, I think the layman consumer in America maybe understood the ands and the its and the buts, but that's about it. I mean, it was a historical look down monetary policy. I basically took it as a historical argument about where they are now and why they're doing what they're doing, with letting them some freedom in the future to move where they want to go. I mean, one of the statements that that I was most bothered by, to be perfectly honest with you, and I'll read you the statement. The famous words, "We will do whatever it takes," offered by Ben Bernanke, will likely be more effective than "we will take cautious steps toward doing whatever it takes." Famous words, as mentioned by Janet Yellen. The second case is when inflation expectations threaten to become unanchored. Basically, he's laying out the argument that in these situations, we will follow we will do whatever it takes of low monetary policy to justify their zero interest rates, quantitative easing, Operation Twist, dollar swaps with the European banks. In the other side of the equation, literally in the exact same paragraph, he says, but we will also take cautious steps to doing whatever it takes. I mean, Jerome Powell, I don't want to say I'm a proponent of Jerome Powell because I'm not a proponent of any Fed chairman, but I have given him a lot of credit for being very straightforward with what he's doing. And it seems to me like the political pressure Trump is putting on Jerome Powell, I see this in the reading of what's happening here, that they are willing to come off their hawkish stance of 2 interest rate hikes this year, followed by 3 more next year. Coming back to Janet Yellen when she was Fed chairwoman, coming back to hey, listen, we will do whatever it takes, but we will be cautious in doing whatever it takes. It was very confusing. It really kind of made me think old school Alan Greenspan, whom he referenced in his Fed speech today. But regardless of your interpretation of what was said, the market's interpretation of what was said was very, very visible. When you're looking at, and I'll just quickly look at this and then we can kind of deep dive into it. But when you look at this testimony was, what was the time on this testimony today? 10 Eastern?
10 East, 8 Mountain.
10 Eastern. So right here is when when Jerome Powell started speaking, okay? Right here is when he got done speaking. Look at the marketplace, how the market took that. The market took it as an extreme positive, right? We will come off the interest rate if the economic data proves we should, right? That goes back to the loose monetary policy statements of, Ben Bernanke and Janet Yellen. So the market took this response as a very, very positive. Now, if the market takes this as a positive, meaning they are willing to come off the hawkish stance the Fed is on, obviously the dollar is going to be the thing that gets beat up the most in that type of, mindset. Now, mind you, he did not suggest or say that they are going to do that. He just left it as an open question that they are willing to do that. Once again, going back to the dovish, the dovish times of Janet Yellen. So here, looking at the dollar index here, here's 8 o'clock, Tim, right there. Here's the speech. You saw the price action get beat up on the downside. So the dollar took it as a negative. The market took it as a positive. But let's give the gold bug some love here, right? Look what happened to gold here. And at the behest of me, I'm not liking what happened on gold today. But once here's 8 o'clock, Tim, boom, you saw that thing just skyrocket. All commodities showed positive response. Dollar showed a negative response. Those currencies that are obviously traded against the dollar showed a positive response, and the market took it as a positive response.
Garbage. The gold rally is not obviously what we expected. We were talking about the perfect pivot trigger there yesterday, and then off of the news and off of the interpretation of what the Fed did, it just took off and rallied. Yeah. Now, you're above the 20-period moving average. We tend to do this as traders, Matt, when we're in a position moving against us. We start to find areas and reasons why maybe it will turn back and work out. If you were short gold, if you were bearish on gold with this candle, do you just take the hit and move on, or do you?
I'm out.
You're out.
Yeah, I got stopped out. My stop loss was triggered above 1,200. So when the market triggered down yesterday, that triggered me into a short position on gold. Don't regret it in any capacity. I'll make that trade a million times in a row. I'll make that trade. That is a perfect technical setup. Obviously, when you're trading, you have variables that come into the equation, Tim. We knew the variable was Jerome Powell speaking today. Nobody knows what he's going to say. It's not like his, speech is, leaked to the media before he gives it. The market's going to respond to the variable. That's trading. It's part of it, right? We have to take that into account. We can't just trade every time there's an economic event coming out, or we're never trading. So I don't regret taking the trade. And if the setup happens again, I'll take the trade again. But no, I'm out. This movement in gold is significant, in my opinion. You got to look at the dollar in that equation, obviously. But this is the biggest bullish movement we've had in gold ever since this bearish downtrend has happened. And this is the biggest 1 week move in gold ever since this bearish downtrend has happened. There is obvious sentiment that is changing in gold right here. Is it a buy? No, not in any capacity. This is not a buy at this point. But for those bearish traders looking to short it, I think we got to wait it out just a little bit. I'm still looking at that key resistance level at 1220 to see how it behaves at 1220. I am willing to get back into a short position here if I start to see weakness coming into that between 1200 and 1220. So I'm not coming off this stance that I'm still bearish on gold. But at the same time, I'm going to take a wait and see approach to see how this momentum smooths out first.
Yeah, it's the biggest green candle we've had on gold since really back in March when gold was trying to hold that 1320 zone and whatnot. You've got a nice week performance. I loved the red candle yesterday. I saw it as an entry point for a short or a bearish put, something along those lines. Just has not worked out. Beautiful candle on the weekly. If you're a bull, I'm not bullish. I mean, come on. No. It's not going to happen in one day. But you've got to respect it.
Tim, the dollar, even though gold is showing tremendous strength today and the dollar is showing some weakness, it's down 0.57% on the day. That's a fairly significant move in the dollar. But the dollar is still above this key level of support at 95. It's still setting on that 50-day moving average. And as long as it holds $95, you can't go bearish on the dollar. The dollar is still reigning king right here. I'm willing to come off that like the Fed. I rip on the Fed, but I'm willing to, if the data, changes, I'm willing to adjust my approach to it. But that 95 level on the dollar index is a significant level of support. The market has tested it multiple different times, not only in the recent history, but in previous levels of the marketplace. So if you're looking at this kind of on a weekly chart here, and I'm going to get a little bit more data, so that we can kind of get a little better perspective here. You're seeing a lot of information coming here at that 95 level. Old resistance, right here towards that level right here between 94 and 95. That is a significant support level, Tim, between 94 and 95. As long as the dollar stays above that level, you've got to be somewhat bullish on the dollar. And if you're bullish on the dollar, you still have to look at the relative weakness from a trend perspective on gold. And the gold bugs have, listen, they have a lot of reasons to celebrate over the course of the last week. It's went from 1180 up till, current price 1213. You're showing tremendous price movement on the daily chart. On the weekly chart, Tim, you're still seeing a pretty significant bearish downtrend despite the positive news coming out today on it. But as all things with precious metals, the analysis has to start with the dollar. And if you're looking at the dollar, that 94 to 95 level is very significant.
Yeah, there's no question. And obviously, there's so many things going on from an intermarket standpoint, Matt. I want you to go to the SPX, not the ES contract, though. I just want to highlight something that could be newsworthy by the end of the day. It will be in the papers if it does happen. Not the ES, actually. The SPX is only by 1 point difference. But the futures market contract didn't hit an all-time high, but the S&P 500 index did hit an all-time high here on the intraday. January 26th of this year, we were at 2875. Today, we hit 2876. Do you think that's going to be on the headlines?
So the high that we've seen right here is 2872, right? Mm-hmm. We'll just say 2873 because it was like 2870. Well, the high was 2872.87. Currently, the market right now is at 2874, 2 points above the high of all time. Yeah, that's going to be significant. That's going to be in the news, no doubt about that.
So something like that coming into the weekend, what do you think that does to public psyche? They pick up the Wall Street Journal for the weekend. Maybe they're a weekend reader of the New York Times financial section or, something like that. The IBD, they're that awesome investor. They come in and they see the headline, stock market hits an all-time high.
It's positive. People with 401ks, they don't worry. They don't get out of it. People in IRAs don't worry about it. They don't get out of it. Traders see that as significant. Tim, you look back in history, and again, as a student of history, I think, as a technical analysis, you're always a student of history. But when you were looking at the 2013 level, and we were constantly, once we broke up above the 2007 highs and we started setting new highs in 2013, Tim, what did we set? Like 50 new highs in the next 2 years?
Sure.
It was like almost twice a week we were setting new highs because that is a very bullish momentum, especially when you're talking about the Dow or the S&P 500. We've seen highs all the time in the Nasdaq. We've seen, those types of things. But when you're talking about the blue chip indexes like the Dow or the S&P, that has greater significance than, say, the Nasdaq does. You're looking at the 500 stocks in the S&P 500. That is the barometer of the entire marketplace. You're looking at 30 stocks in the Dow. Those are some of the biggest stocks in the world. And when you're talking about those blue chip indexes breaking out of all-time highs, that is a very positive type situation. For new traders, they always look back in the past and they say, oh, I wish I would have bought in 2013. Look what I could have done. I wish I would have bought in 2010. Look what I could have done. But the reality is breaking out of new highs is a high probability type setup that momentum will continue. Because if you're breaking out of all-time highs, Tim, momentum has been pushing to the bullish side. Momentum does have a tendency to continue, and that momentum can be from a technical perspective, from a psychological perspective, from a fundamental perspective, or from an economic perspective. And from an economic perspective, you have an economy. Even Jerome Powell stated that today. He said, in fact, let me kind of read you his last statement in that very quickly. Just give me 1 second. Let me find it. He says, the economy is strong. Inflation is near 2% objective, and most people who want a job are finding one. My colleagues and I are carefully monitoring incoming data, and we are setting policy to do what monetary policy can do to support continued growth, a strong labor market, and inflation near 2%. Tim, if you read that, just that statement, inflation at 2%, unemployment under 4%, everybody wants a job and the economy is growing. There's nothing, if that's the statement, that is an economy that is growing tremendously. Now, whether you agree or disagree with that statement might be your own personal perspective, right? It does lead me to believe that Jerome Powell does not buy his own groceries, but at the same time, he sees this economy is growing. The economic data supports it. And because of that, you have momentum there. You have momentum from a technical breakout situation. You have momentum from a fundamental earnings position. We're coming out of an amazing earnings. The economy is growing. Jerome Powell just hinted that they might be a little more dovish. What's there other than what else is there to analyze other than let's go buy something?
Yeah, obviously international risk and perception on politics is going to be a personal
There's
thing.
all that.
There's all that. And that's actually what they've talked about a little bit, that there could be potential conflicts coming up. They said in the Fed minutes the other day as well. That may not be a big part of the speech, but
let me ask you a question. At what point in the financial history of the U.S. markets has there not been those variables?
Well, let me think. Probably never, I'm guessing. There's always been political risk and conflict and things going on. I mean, you've had tensions, you've had global trade issues, you've had all kinds of stuff. Of course, we've been calling the market bullish, Matt, and the market continues to be bullish, and it's breaking out, showing more strength than I think people are respecting, quite frankly. The headlines are going to be great. They're going to look good. The RUT is breaking out. The ES is breaking out. The Nasdaq is setting up for a breakout. Is what we were talking about earlier in the week, that technology, I think, can play a huge role in September and October if we are catching a breakout and run. So we're going to go back to the old bag, I'm sure.
Okay, well, think about it. Okay. Look at this breakout here, right? Nice strong candle in the breakout, but it didn't have any follow through. Mm-hmm. Okay. That breakout came right back down, but look where your overvalued was on the time of the breakout. You were overvalued coming in to the breakout. Okay. Look at this breakout here. Where's RSI? The relative strength indicator is 58 and increasing. That tells me that breaking out of this all-time high, this market has room to run from a technical perspective.
Yeah, I agree with that. I think that you've got to respect it. I'm calling it a +1 still, because I can't get that excited about a 0.64% move. I will kind of have to reference some of the volatility in the action. If the market's not moving 1.5%, 2%, I'm not going to start calling it high-fiving, everybody on the street. The reality is we have a nice little breakout. We're hitting an all-time high. It's doing it very methodically, kind of probably like a Federal Reserve luncheon in Jackson Hole, Wyoming. It is very much in order, in line. It's doing what we would expect with this action today.
Yeah.
Yeah. Take a look at RTY. I think the Russell, we have to talk about this. I was listening to CNBC this morning, and they were mentioning how so much with what's going on with trade, these companies at the small cap and mid cap level, they are going to benefit from these policies because they're not dependent on international trade. Do you buy that logic on small caps?
Yeah, we've said that for the last 6 months.
Yeah. And so this thing now playing breakout, showing an all-time high, Matt, 1728.
In fact, did they watch the halftime report from 2 weeks ago? I mean,
it must have.
We've been saying that for a very long time, that small and mid-cap stocks will benefit from these trade policies.
So would you rather go long the S&P or the Russell if you had to go long one or the other right now?
Russell.
You take the small caps and move it up the list?
Oh, yeah. I definitely believe this can run on the breakout. It's definitely going up the list right now, and we said that, the Russell was lagging when it was going through its, ascending triangle situation. It has shown strength, Tim, and it's definitely catching up. There's no doubt about that. I'm moving it up there, probably past the S&P 500 right now. I'm still Nasdaq, but Nasdaq, Russell, S&P down.
Well, bring up the NQ, because I think that's where the debate lies, in my opinion. I agree. Small caps have moved way up the list for me. The S&P very bullish. But what I would like here, and from an entry point perspective, I'm more interested in the NQ because the RUT already broke out. It broke out on Tuesday or whatever day it was. Here, the NQ, we have a green candle today pressing resistance. We might get the breakout on tech early next week or even here at the end of the day. NQ is your number one right now in the index ranking?
Oh, yeah. Yeah, it is. Yeah, NQ, and even though it has not broke out, the Russell does. The Nasdaq has shown tremendous strength year to date. It showed no weakness, even in this consolidation pattern. It really hasn't shown any weakness. And you're looking at a significant breakout of 7,500, which is breaking out of a significant whole number. I'm definitely looking. And coming back to what I was saying on the S&P with the RSI, you look at the relative strength indicator here. Let me pull it up so you guys can see it. You're crossing, hooking above 50. You're currently 56. Tim, you don't get that type of technical setup on the Nasdaq on a breakout very often when it's still undervalued. So, yeah, I think a breakout of 7,500 is significant on the Nasdaq.
Cup and handle, ascending triangle. What are you calling that pattern right there?
Right now, I'm calling it a cup and handle. You got your cup right here, your handle right here, breakout. Now, the only difference between the cup and handle and the ascending triangle is, as you can see, this is approaching the breakout channel. It doesn't break out. It consolidates a little bit more, and then eventually it breaks out over here. So if this is a cup and handle historically, it will break out right now. If it's an ascending triangle, it will consolidate a little bit and then break out. But the patterns are very, very similar. One just breaks out now, one breaks out next week, or the week after. But the pattern is the pattern, and you're looking at the breakout regardless of if it's an ascending triangle or a cup and handle pattern.
Take a look at Bitcoin for a minute. You know, I find it very interesting this week that Bitcoin had a bunch of negative news. In fact, the SEC rejected like 8 other bids to try to get a Bitcoin ETF. They don't want to do it. And yet Bitcoin didn't sell off. Usually when Bitcoin's got any kind of negative news from the SEC or from those bodies, the thing will get hit and take it right on the chin. I read a report that it's possible that all the crypto fans and investors, they're holding into Bitcoin because they're seeing it as the stable currency to invest in, while the other altcoins are getting beat up. I don't know if you buy any of that, but it's interesting to see that it's not selling aggressively.
Good luck with that analysis.
Well, I mean, Bitcoin, we're going to keep talking about it regardless.
Tell me you brought it up. Do you buy into that analysis?
Yeah, I think that when traders have to swap coins back and forth, they have to hold core Bitcoin to be able to do that.
That doesn't mean Bitcoin has to hold up, though.
It's becoming kind of a fiat for currency, or for cryptos, I should say.
I'm sure the crypto nerds love that one.
Yeah, I'm sure they do, but it's kind of this quasi type deal. Bitcoin is holding security against some of the other coins that are going to take it on the chin. But when the crypto market goes back up, it's not going to go up as much either. It's that more stable crypto, which is a very crazy thing to say on something that just went from 8,500 down to 6,000.
Yeah, down 66%. That's the stable one.
Yeah, it's the stable one.
Come on, Bitcoin. Come on. That's the stable one. It's only down 66% year to date. That's because it's not Ethereum or Litecoin or Ripple down 80 and 90%. This one's the safe haven. Is that the argument we're trying to make here? That Bitcoin is the safe haven of the crypto market. You're only going to lose 66% instead of 90%.
Oh, the past, brother. You got to think in the future, right? That percentage gain has already happened, come and gone, and moved on. And here we are down at the bottom. I'm still not a trader of this. I'm still just a watcher, holder, think different kind of things.
Listen, I don't believe Bitcoin's going away anytime soon. And I'm not suggesting it's a bankrupt, corrupt type thing. The whole argument that this is a safe haven is utterly ridiculous to me.
Yeah, I do want to look at the economic calendar and the sectors as well. Let's kick over to the market skyline over there on tackle trading. And let's bring up the heat map. And by the way, welcome halftime crew. Give us a quick like and share if you're here watching us live on a Friday afternoon, Fed Testimony Day. All right. Okay, heat map green like you would expect, Matt. Go back up to the heat map. Philip Morris and MO are down. Cigarettes are getting
sold. Like cigarettes right now.
People do not like cigarettes on a Friday.
The economy's doing good. People don't need vices, bro.
Google back up, tech back up, green everywhere. That is a very smiley face heat map right there for sure.
Have you already done it? Have you already put your smiley face on the heat map on Twitter?
I'll wait until it settles, but I will put the happy smiley face on my heat map here today.
What's interesting is the market's positive across the board. Obviously you're starting to see some movement in Adobe, Salesforce, Comcast, Netflix, all doing really, really good today. But looking at the utilities here, market's doing really good today. Utilities still up today. They're still pivoting off their channel. We already kind of looked at all the indices, quickly looking at kind of the commodities. You're seeing support across the board in your commodities, kind of with that dollar coming back down. Looking at your different sectors here, we identified a couple different sectors yesterday that we were fairly bullish on. One was real estate, Tim. Is this a confirmed pivot for you on XLRE?
Pivot trigger entry, absolutely. Yeah, there's no question. I mean, whether you take the trade or not is a personal decision, but I don't mind taking this into a Friday. I don't generally love new entries Friday afternoon. That's a personal perspective, but just the way I trade that way. If I'm going to do something here, it would be a spread into the weekend, even though I have used XLRE for a straight long call on some of those other pivots, Matt.
I did last 2 times.
I probably would do a bull call spread just to mitigate the risk of the weekend time decay and stuff like that. Subtle thing, but
for me, I'm waiting on the last couple hours of the market to kind of see if we're going to close above the previous level high. And if we close above the previous level high, I'm going to call that confirmation. I'll take a trade, and I'll probably do the bull call with you.
Yeah. XLRE looking great today. In fact, on my bullish sectors, it was the first one I put down on the list. I actually still like XLY, by the way, the consumer sector. I like the seasonality of it. I like the potential for it to continue to run here. It's not a new entry point per se, but the sector is strong. You could go find individual entry points. Tech is beautiful. We've talked about that. Yeah, XLP, I've got bullish.
Short-term, little bit of a pullback. Look for confirmation. That's an interesting little setup. One I don't love.
I'm more neutral on this one than bullish. I'm bullish, but I like the other ones better. Would you agree?
No, I would. It's lagging. I'm just this little tiny pullback. I don't actually consider that a bullish retracement, just a little pullback buy type opportunity. Basic materials is just flat out neutral for me right now.
I've got a neutral call.
Neutral, great for cover calls right now. Energy, Tim, we were talking about it potentially setting up from a bearish retracement perspective yesterday and the day before. Are you coming off that with the movement in energy today?
No, some of the best bear retracement setups are in the energy sector across the board, even like an ExxonMobil, a Chevron. I think that if you're going to be a stock picker in energy, you're going to find good kiss goodbye kind of patterns where they broke support and came back. The more conservative call would be neutral here, but I've got a 0 to -1 call on.
I got a -1 on it.
Yeah.
I got a -1. I'm looking for shorting opportunities, but I do want to point out one thing really quickly. Again, kind of what I said on XLRE, I want to wait till kind of the close coming into today to make sure it closes above the high of yesterday. Same thing kind of occurs yesterday when we're looking at the energy sector. It tested down a little bit, came back up intraday, did not close underneath the previous day's low. That is not confirmation. That's why confirmation is so very important. You see it come back up here today. I'm still looking for bearish setups on XLE. I'm not taking this as a potential reversal right now. I still see that as a bearish retracement. XLP, Tim, showing a little weakness today, but overall, I still really love this trend. I still really love this pattern. So I'm still looking for confirmation on the upside on this consumer staples sector. Looking at XLV, healthcare just doesn't want to slow down. Just slow burn up. That's what it is. Just a slow burn up. Doesn't really retrace. Just kind of just gradually continues to go up. XLU, utility sector, looking for a potential pivot going back up. You can look at that for next week coming into the market. Don't see that confirming today. And financials just kind of in a no man's land, neutral right now.
I agree. There's so many good bull retracements on the defensive sectors, P and U specifically, the staples and utilities. Financials are more neutral on. I know there's some individual ideas in there. One interesting thing in the financials, Matt, are the brokers, the E-Trade, the short.
Let me ask you a question before you do that.
Yeah.
You said a lot of bullish retracements, really good pivots happening on those defensive sectors like, consumer staples, food-based products, like, utilities, obviously a very defensive type situation here as well. But what about real estate, Tim? Would you consider real estate, XLRE, an aggressive sector or a defensive sector?
That's a really good question. I think the way that they've built it with all the different REITs and holding companies in the environment we're in, I'd consider it more defensive. I think money is, if you look at the patterns, it's more correlated to, say, utilities and staples than it is the other ones. The pattern is much more in line with that. Yeah, I would call it defensive right now.
Before the subprime market bubble, all finance and real estate was extremely defensive, right? It was really the 90s, early 2000s that really turned, the financial sector into an aggressive sector. But I still consider the financial sector to be an aggressive sector, but real estate I still consider to be, more slowly consumer driven, safe haven type situation.
Yeah, I that's why I've got it as well. A lot of stuff going on in the sectors. By the way, I will dig into those individual companies within those sectors tonight and get some prep for our option report over the weekend. Tackle 25 stocks.
Great day today.
It's having a beautiful day. Some that's
bips. It just never is for the Vips.
That poor dog. Oh,
Oh, the
yeah.
poor Vips. You're such a
Yeah.
dog. I want to kick you off the 25 so bad my teeth hurt.
No, you'll get your chance next year, but you
Yeah,
watch. They'll settle the
it's get
tariff stuff. The
removed.
VIPs will go up 300%, and we'll be
Hey,
talking about
now
it
mind
every
you, I
year.
just want to remind you that we removed AMD to place the Vips on there. I just AMD's up just to show you this.
All right.
Just to show you this. I just want to remind you.
Wasn't that your idea?
That was not my idea.
Calm down.
That was no. No, it wasn't the VIPs. I think we removed AMD for applied
Intel.
materials. Great
and
decision,
Intel.
mind you.
All right. Good enough, Matt. Apple, Valero, and DHI are on the Tackle 25 and looking great today. Why don't we look at those? I actually went through the Tackle 25 this morning, do a thorough weekly review of it, and I love Apple. I still love the breakout, the potential. It's a juggernaut like we've continued to talk about. If you're in a trade on this, Matt, you're probably not coming off a bull position here. No, I don't see any reason yet either. Valero, I really like Tackle 25 stock. Breaking out. Just tons of strength. Beautiful stock.
Good breakout.
DR Horton, DHI, in that real estate call like we were talking about. Nice little pivot.
Oh, hair trigger up above the 200. Not a bad play. They're up above 45.50.
I agree. Some that I am looking at more bearish. Facebook. Tell me how you'd play this Facebook here.
I don't know. I'm in it right now. You tell me how I should play it.
The market's up and it can't find strength. The market has done well. It can't find it. It gapped down 20% on earnings. It should have held 180 and ran. It didn't hold 180 and run. It actually broke below that. This thing is a dog to me. And I really, I don't know what to do with it. I will say this, if the market ended up failing on this breakout and this broke 170, it's a huge bearish opportunity. I think it's more of a neutral play right here, quite frankly. I don't see anything directional that makes me want to take a position.
I got a bull call spread on it right now that I'm upside down in. I got a stop loss under 170. I'm going to let the stop loss play. But if I was looking to get into something new, no, there's nothing to see here. I think you're dead neutral here. Your opportunities, in my opinion, are still back up above the 200-day moving average, as well as a breakdown of 170. A breakdown of 170 could be significant on the downside. And I'm not prepared to call that, Tim, because, you do have a very good support here at 170, 170, 170, 170, 170 resistance, 170, 170.
Mm-hmm.
That 170 level is very significant. A breakdown, you could get into 150 very aggressively.
I agree. And I was looking at this in the Cash Flow Club last night. Really enjoyed doing that show with the Tackle Trading Pros. And we were talking about how to adjust. We had a trader who had a bull put spread on it. And I was showing how if you learn some advanced techniques, you can manipulate and change the nature of those spreads to hedge them. Getting out is never a bad idea if you have a stop loss hit, but there are adjustment techniques. Matt, do you ever take like a spread, turn it into something else?
Oh, of course. One of the benefits of trading spreads is it gives you options to adjust. One of the benefits of trading options is it gives you the benefit of adjusting. So absolutely, adjusting is part of anybody's trading plan.
Yeah. Interesting on Apple. I think that 170.
I heard a tremendous amount of compliments out of that Cash Flow Club last night.
We had fun. You were
on fire.
I was on fire. And I'll tell you, it was like jazz, Matt. You didn't really have a plan. I played the same 4 chords. I just went and jammed for an hour.
In fact, one text message read, quote, "You guys are always good, but Tim was particularly good tonight." I was like, okay, I love it.
That's nice to hear. I love doing it, and the thing about it is when you have a chance to engage, those pro members and kind of really dig into some concepts, it's a lot of fun. It's a lot of fun teaching this stuff and helping people build their businesses and whatnot. Obviously, we have a passion for it. Facebook here is one of the FANG stocks. If I had to pick one of the FANG stocks, we did this yesterday, it would not be Facebook. It may not be any of the FANG stocks. I like that CRM breakout more than anything. Netflix, tons of.
You take every one of these, Facebook's showing weakness. Amazon's just the juggernaut it is. Look at 1925 breakout. It wants 2000. It just does. Apple's an absolute juggernaut right now. I like the bullish momentum coming into Netflix after they, upset their consumers. Google here, kind of in my estimation, a little bit of no man's land here, Tim. Looking at a little bit of a longer term symmetrical triangle. And just to kind of reiterate kind of what that is, you look at connecting these support levels right there, connecting these resistance levels right there. You have this symmetrical triangle forming, which could break out one way or the other. The typical probability on a bullish symmetrical triangle is it breaks to the upside. But these things, when you start to compress support and resistance like this, you have a tendency to create this powerful breakout of the channel. So that's something to keep your eyes on there. But Tim, you looking at CRM, this to me is one of the most significant breakouts in the market today. We talked about it yesterday, the breakout of 150. It broke out with force out of 150. The volume in the market today is going to be low, right? It just is. It's going to be very low today. So, and that's going to be across the market as a whole. So Monday, Tuesday next week is very important to see if we are in fact confirming these breakouts, Tim, because again, coming on this Friday with the Jerome Powell giving his speech and, a lot of the traders in the Hamptons already, the reality is you're not going to have strong volume. Okay. So I'm looking at Monday and Tuesday to see if the volume comes back in and pushes these breakouts in the Nasdaq, in the S&P, in the Russell 2000, and in individual companies like CRM. But I'm looking at CRM as a significant bullish opportunity with that breakout of 150.
I agree. It's one of my favorite companies.
The only problem, that
29. Well, you could still probably swing trade that for like 2-3 day pop. You'd have to do like a 1 or 2 ATR target.
I'm swing trading that, and usually I don't. Usually I'll wait with it so close. But with the significant breakout on CRM, you could see a few points moving up on that breakout.
Yeah, for sure.
You just can't hold that through earnings.
I do like a couple other stocks on the 25 for potential trades, not necessarily in the positive way. Look at X, US Steel. I still have a bearish short-term call on this, Matt. Underperforming the market in general, been getting crushed since the earnings report. Bear retracement, little green candle, doji here. Could be set up next week for a sell-off.
Oh, yeah. I still have put options on it, sold calls. I own the stock, obviously. So yeah, I'm still weighted to the negative on US Steel right now.
Freeport McMoran, FCX, setting up bearish as well with that gold, moving gold, bringing it back up into those moving averages and whatnot. It just is going to go the way of gold. If gold continues to rally, Freeport will probably recover. But if gold turns back down, I would expect some pressure. If I own equity on this, I'm probably hedged with put options. There's no doubt about it. Neutral, I want you to look at Boeing. One of the reasons why I've got a neutral call on industrials is I look at the big names like Boeing, and they're just stuck in long-term ranges, Matt. There's no doubt that thing is just in the middle of a 325, 375 long-term kind of channel there.
Tim, it's been neutral for so long that this price movement in 2017, where Boeing went up tremendously, the 200-day moving average has actually caught up to it despite it never trading bearish.
Yeah. Technicians call that a time correction. An interesting one on BABA. Now, we talked about this one earlier in the week, and I still want to get your take on this. I actually am looking at this for some potential bearishness, Matt. The market is rallying today, and it's got a red candle. You had selling off the 200-day moving average from the earnings reaction yesterday, started showing a ton of pressure. I'm currently neutral until it breaks the low of the candle from yesterday. But you tell me, I'm looking at that for maybe a quick swing trade to the downside.
It's BABA. It's bearish. I read the earnings report. I thought the earnings report was good. I did. They had around a 60% increase in year-over-year sales, something along those lines. You're coming into the holiday season. BABA didn't do fairly well last year coming into the holiday season. BABA did pretty well coming into that. Price appreciation about 5-6%. Nothing to get too upset about if you're looking at the shorting. I'm not doing it. I don't feel comfortable with it. but I could certainly understand a short underneath yesterday's low.
Yeah. It's going to be a volatile stock. There are some strategies that I think could work in here, things like ratios, or maybe even something more like a directional bear put spread. I have not played it yet. I'm just watching it. I'm looking at those red candles in that pressure mat, and it's got me, it just gives me the feeling that it wants to sell.
Well, and the way you'll approach that, you'll get creative with what you're buying versus what you're selling in the options market. For somebody that's really, new in their first year of trading, this is something that could spike one way or the other. I just don't feel comfortable with it.
Yeah, I get you. And then one I want to talk about before we get into our setup on Nike that we're going to go through today is Tesla. I actually read that Tesla hired, was it JP Morgan, something like that, to take the company private, Matt. They've made an official.
They now have two of the largest banks out there to try to cover up their fraud.
So are you telling me that Elon Musk is going to spend hundreds of millions of dollars just to cover up the thing he did?
Yes, absolutely. Who better to cover up fraud than Jamie Dimon? This is a marriage that should have been made, 2 weeks ago when he literally put out the funding secure tweet. So yeah, whatever, Elon, come on.
So you don't believe it?
No, I don't. Absolutely not.
So do you think? Well, here's the thing. Do you think that he will take the company private?
No, I don't think he's taking this company private.
You ever heard the old phrase, "The webs we weave"? Right? Maybe he
Elon Musk found himself in a very, very nasty situation created by his own doing, and now he's trying to slime his way out of it by going to the institutions to try to make it look legit. This is a complete and utter joke. And the more Elon goes down this road, the more I have lost respect for him.
Well, it's okay if you're not Elon's friend, but I got to figure out how to trade this thing. I don't have anything on it. I haven't touched it in a long time, and I trade Tesla a lot,
straddle
but
it, strangle it.
I don't know until I get more clarity on where it's going.
Ridiculously priced.
It's so hard to play something that's so news driven and randomly news driven. It's one thing to do earnings plays when it's a planned event and you can kind of predict the volatility rise or the volatility crush or whatever is happening. But when you're dealing with a company that could be in the news on Twitter on any given day and just randomly run 5-7%, man, I just had to put it on the shelf recently. It's going to be interesting to watch that storyline play out. I would not be surprised, Matt, if Tesla does go private. And it could be that he just got caught in this, the egg got cracked and he had to scramble eggs. I don't know. But I will say this, they are moving things in that direction. You don't hire two firms, take you private, unless you are going to make them do their honest job of
unless you're trying to cover up. Yeah.
Maybe.
Listen, even if Elon takes Tesla private, I will still believe that tweet was sent as a trolling to short traders.
Sure. Yeah, I agree in many regards. Obviously, when there's smoke, there's fire. There's something going on with that. There's no doubt about it. Let's take a couple of looks at a few different companies. And the big one I want to do today, Matt, is a Nike.
Last thing I'll say on Tesla, There is no evidence that suggests that he had funding secured, regardless of what banks come in to now try to do a deal. There's no evidence that suggests he had funding secured when he sent that tweet. That is stock manipulation, and that is a crime.
So I kind of want to do an Elon Musk impression in the voice of Bill and Ted. Dude, like the Saudis, they got lots of money, right? That's funding secured.
That's about what it was.
That's about what it was. All right.
I digress. I'm not on Tesla.
You're not a big Tesla fan. You're not a big Elon fan right now. I think that we've got that part. It's going to be interesting, though. Obviously, we're going to keep coming back to it. We got to talk Tesla. If he's in the news, you got to keep talking about it.
No, and it's a fanboy stock that a lot of people invest in. A lot of people trade. You got to keep talking about it. People want to keep investing in Tesla. That's their right. That's fine. I have no problem with somebody investing in Tesla. I have no problem somebody shorting Tesla. I have no problem with anybody's take on Elon Musk or Tesla. If you love him, you love him. If you don't, you don't. That's fine. I really don't care. It doesn't change the fact that what he did was wrong.
Bring up a couple of stocks that had earnings overnight or this morning that I want to talk about. HPQ. Little gap down back into the range. When I see a gap down that feels normal to me, there usually is an opportunity to do something like a naked put or a bull put. HPQ is such a boring stock. Look at the volatility on the right, Matt. It
Yeah, it's
moves
nothing.
20, 30 cents a day. There's nothing really here,
Nothing
but
there.
big company, obviously. So we look at it. VMware, VMW, not VM with a V Victor. Yep. Same kind of deal, gapping back into the middle of the range. These are volatility plays, guys. If you learn how to play earnings, there are things you can do with this hold through earnings type strategy. Neither of these were on our report from the last weekend, but one that was, Matt, is Splunk, SPLK. I've always liked the name of this company, by the way, Splunk. It just is cool. I don't know why. It just is. It grabs me. I had this as a bi-directional trade on last week's options report, Matt, and man, this thing moved. And the volatility is a lot higher. It's up 17% today. How do you read that?
Significant breakout.
Yeah, I agree.
Yeah, to me, when you see these types of significant breakouts on earnings, and this is just me personally, I have a hard time taking the trade right now. Like I just have a hard time. And it doesn't mean it's not legit. It certainly is. Personally, I have a hard time after some 17-point move to buy after a 17-point move. I like to let the next few days kind of wait out, see if there's some profit taking on the breakout, let that sucker come right back down to 120, correct at 120, and then I like it. But, or let it go up to 130, retrace back down to 125. I like to see the trend and the pattern kind of established after a move such as this.
And I had this one on the neutral volatility watch from the weekend. And if you guys watch the options report, I'm going to have more of those in the future. One of them that's going to be on that neutral volatility watch is going to be Nike. We'll get to that in a minute. Autodesk, ADSK, Matt, one of the best gainers in the S&P 500 today. Up, boom, 15%, $20 on the price. I mean, just a huge gap out. Those gaps can take some time to fill, but you got to pay attention when you catch those. There's no doubt about it. And then the one thing I want to do thoroughly here today, Matt, is actually prep and kind of talk about a volatility play on Nike. One of your favorite strategies is the straddle building into the earnings when we're this far out, right?
Mm-hmm. No, the reason I like it is really your only factor here is time decay, right? So basically what a straddle is you're basically taking both sides of the equation. So on the risk graph, if your T is like this, your risk graph looks like this. So you have this V-shaped risk graph where you profit as the stock moves down or you profit as the stock moves up. But that is a directional trade. Even though it's a bidirectional trade, it's still a directional trade. But when you accompany it with volatility around earnings, you can take out the directional risk and you can mitigate the theta risk. And that's what we like with straddles coming into earnings. Now, as you can see on Nike's volatility right now is implied volatility is currently at about 18, right? So what happens before an earnings announcement, such as this one coming up at about 5, 6, that'd be 9:25. So about a month from now, we're gonna be looking at Nike's earnings. About 4 to 6 weeks before the earnings announcements, you will start to see volatility increase coming into the earnings announcement. For example, if we look at just Nike, we'll look at a couple other examples here. If I look at a little bit more time frame, okay, looking at kind of Nike just to kind of show you the historical type situation here, okay? So here's all of Nike's earnings, right here, right here, right here, 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 and here. As you can see, about 6 weeks before the actual earnings announcement, volatility starts to increase. Volatility increases. Volatility increases. It's like clockwork, Tim. You have this very consistent pattern. Before earnings, volatility increases. After earnings, volatility comes down. Now, there's a very simple reason why volatility increases coming into earnings and why volatility decreases coming out of earnings. It's because the investors, the institutions, the hedge funds, the individual investors, before earnings are released, a lot of times they will buy insurance, i.e. put options, to protect the investment. And the best way to protect an investment is by buying cheap options. You don't protect an investment by buying expensive insurance, you buy cheap insurance. And so what happens is as the market comes into that earnings announcement, everybody's buying insurance. And as that happens, it drives volatility up. Now, on the earnings announcement itself, you carry the insurance through the earnings announcement. But after the earnings announcement, there is no reason to hold insurance, because the only reason you're buying insurance in the first place is to protect against the uncertainty of earnings. And now that what was uncertain before the earnings is now certain after the earnings. For example, let's say earnings per share is just 1 and they report 1.25. Now we know it, the market's going up. I don't need any more insurance because the market, I now know what the earnings announcement was. Let's say the market goes sideways. Well, I don't need the insurance any longer. I now know that what happened in the market and in the trend, and I can make some decisions over my investment in Nike. Or if the market goes down, either one, I can just close the insurance position at a profit, offset the loss on the stock. But regardless of the outcome of the earnings announcement, you now no longer need the insurance. And that's what brings volatility down. And so when we're talking about straddles or strangles, we're basically trying to, this is basically a volatility move. You know, the hardest thing in trading, I think, is outside of just getting over the difficulty of being a new trader. I think the hardest part of being a trader is, you know, a technical analysis, really projecting future expectation. But this trade, this straddle or this strangle, has nothing to do with the technical analysis. It doesn't matter what this trend is. It doesn't matter what this pattern is. Because if you look at the technical trends here, the trend is changing constantly. The pattern is changing constantly, but the volatility doesn't. It just stays in this specific pattern because it's like clockwork, guys. Once we're taught how to do something, we just do it over and over and over again. So what my projection here, Tim, is from volatility at this point is for over the next month to volatility to rise into this level. And the only thing I'm going to project is the fact that volatility will go into the exact same levels that it historically goes into, right? So it's an easy projection. So instead of buying a call option or buying a put option to take the directional risk out of the equation, we basically buy a call and we buy a put. That will create a V-shaped risk graph that will benefit as the market goes up. So for example, and I'm just going to go out to my rules on Nike here, and we're going to delete those. In fact, I think we put this trade on. Yep, there we go. Okay. So basically we put this trade on yesterday, but I'm gonna assess it like we don't have it. So we can look at all the Greeks and all that, and I'll get paid a little bit less. Okay. So now we don't have a trade on Nike. All right. Now, Tim, when it comes to any option strategy, you always have 2 clauses in the contract. And when you're dealing with call options or put option, the contract reads you have the right to buy or sell the stock at a set price on or before a set date. The set price is based on delta. Mm-hmm. The set date is based on theta. So the first thing you have to select here is how much time you want to be into the trade. Now, theta is a rapidly accelerating decay of the price of the option as it gets closer to expiration, which means the closer we are to expiration, the more percentage out of the value of the option we will decay. So for example, I'm willing to hold this up until earnings, which is less than 30 days.
Well, let me speak to that for just 1 second, because it's kind of like going to the grocery store and buying bananas. If you get too green, it's going to take forever before you can eat them. If you get them too ripe, then you're not going to be able to eat the whole bunch. You got to be right in the middle. And maybe I'm just hungry and need some extra fiber and potassium in my diet. I don't know where the banana thing came from, but I like it. If you go all the way out to like the January 2017 options, those are green bananas. You don't need that much time. You don't need the 300-day options. You don't need the 200-day options. They're not going to get ready for you during the course of your trade.
Well, no, but I mean, if just to kind of reiterate the point, look at this. With 7 days left in the contract, I'm just going to go at the money here. You have $65 left in that contract. The decaying rate is $4 a day. $4 divided by 65, you're decaying at 6% today, and that will escalate over the next week. So with 7 days left in the option, you're decaying at 6%. With 28 days left, going to the at-the-money contract right here, you're decaying $3 out of 131, which is 2.1%. So with 28 days left in the contract, you're decaying at 2.1% a day versus 6% with 7 days. With 56 days, again, going to the at-the-money contract, you're decaying at $3 out of $290, which means you're decaying at 1% a day. Okay. So basically you're decaying at 1% with 56 days in the contract. You're decaying at 2.1% with 28 days, and you're decaying at 6% of the value of the contract. And basically what I'm trying to show you here, guys, is just as you get closer to that expiration, you start to increase that decaying rate. That is a danger zone for the buyers of the option. Now, for me, Tim, I want to do the 56-day contract because over the next 30 days that I'm willing to hold this, I'm decaying at 1%, 1%, 1.2%, 1.3%, 1.4%, up until that next 3-4 weeks where I'm decaying at 2% a day. I think that is too much time decay to offset the increase in volatility, which we will project. So for me, I want to go to that next expiration date outside that 60-day number. So if the 60-day contract is somewhere around October, I want to go out to this January 147-day. Now, could an advanced trader say, well, no, Matt, I'm going to manage that October 56-day contract? Yes, that's fine. But I still think it's a mistake because you're going to be eating up into too much time decay. If I was holding this straddle over the next 4 days, Tim, yeah, going 56 days out is fine. But I'm holding it over the next 3-4 weeks, which means I need more time. So the first thing I have to select is more time. The next thing I select is I have to select the strike prices I'm going to do. Now, the difference between a straddle and a strangle, which are both very similar trades, a straddle is basically you're just trading an at-the-money option by buying both the call and the put. So as you can see, I'm buying one call at 82.5. I'm buying one put at 82.5, and that is going to create a straddle. So if I did this on Nike and I do a straddle here at 82.5 by straddle, what it creates is a risk graph that looks like this. Okay, you have this V-shaped, type risk graph. On the flip side, if I do a strangle, say I want to strangle the position, and I'm just going to kind of come out here, to close to 25 deltas out of the money. If I wanted to strangle it, it's a very similar type of trade here. Instead of the 77.5 call, we're doing the 90 call. So we're basically going out of the money on both sides of the ledger here. And this is what the risk profile looks like. Okay. So it's more of a horizontal on the bottom with the V shape coming on the left and the right hand side. Now, Tim, how do you go about selecting if you want to do a straddle or a strangle? Both similar trades. The strangle is going to be cheaper. Obviously, we're paying $375 for the strangle. We're paying $930 for the straddle. You'll make more money on the straddle. You'll make less money on the strangle, but it costs less.
I think it really comes down to the break-even points based off the volatility and the time decay. So what I do personally, Matt, is I would set the risk graph a little different beyond the basic starting point. A risk profile by default has one line plus an at expiration line. But if you're not going to hold the trade until at expiration, I mean, that line is there and it's helpful. But I want to make sure that I'm plotting out all of the different plot points that could happen and then making sense of them. It's really about critical thinking and problem solving and all that kind of stuff. I don't expect Nike to make a 30% move in price, right? I am slightly bullish on Nike because of the trend and the market condition.
I don't care about the price. I don't care if it goes up or down.
I agree. But if it gets stuck right in the middle, I better be able to make money just from a volatility build. And the other thing is, I don't assume it's going all the way to 31.
Complicated though. Yeah. Right? Because I think we're going down the road of making this way too complicated by saying I'm going to go to the risk graph, click on random buttons and try to create something that looks good. That's not going to be helpful for new traders. Would you agree with that?
It depends. I mean, but it would be the way that I would do it. I would go in like I'm going into the fridge, not knowing what I'm going to cook, and start fiddling around
But you know
until
the
it is what it
ingredients.
is.
You know, on a straddle, you're going to start it at the money. You know, on a strangle, you're going to start with 0.25 delta. So you can't just say to a new trader, go click buttons. You got to give them some direction here.
So then do the straddle. I mean, if you're trying to give somebody direction, you don't have to have a debate between the two. Straddles are going to be more pure in terms of a volatility build. You're not going to have the break-even points that you have to consider. It's cheaper to do the strangle, but the straddle is more of that volatility play. If it really just comes down to
the volatility as well. I mean, my point, Tim, is that you got to give people specific roles. You can't just say click buttons on a risk graph and see what works. I mean, yeah, somebody 13 years of experience, they certainly can do that. But, you know, with 100 people watching this and saying, okay, well, which ones do I click? You know, I think you got to be a little bit more specific. I mean, a straddle, you want to work out the money somewhere around 0.50 deltas. A strangle, you want to work out of the money around 0.25 deltas.
Yeah, but when you get into strangle, though, you have a more complex analysis on whether it will work. So if I'm trying to decide between one or the other, and if I just want simple, the straddle's simpler. Would you agree with that?
I would say the straddle is simpler, yes.
Right. And so the strangle does require a deeper analysis than just that volatility is going to 31%.
A little bit. They're very similar trades, though.
Right.
So, okay. So what I'm doing here is I'm projecting out based on the probability of expiring cone where this market could be in the next 30 days. So basically what I did, guys, I did is I know it's kind of hard to see because our video here, I just looked at these two numbers to just kind of show you profit loss here. Now, the first thing we're going to look at, Tim, is we're going to look at the straddle, and we're going to project, you know, theta, delta, vega to kind of determine which one is the better trade. Okay. Mm-hmm. So I'm holding this trade. So the first thing I'm going to do is I'm going to change the date, which will change my risk graph. Okay. So the risk graph you want to look at here is this purple line. All right. So if I'm willing to hold this before the earnings announcement on 9/25, let's just say, let's go to 9/21. Okay. Now, as you can see, I adjusted the time frame. All right. Now, as I adjusted the time frame, I know per contract, I'm going to lose about $91 on theta. That's what I know. Would you agree with that, Tim?
Yep.
Okay. So when I'm doing the straddle, I know I'm going to lose $91 on time decay. Now, on the strangle, clicking the button down here, I know I'm going to lose right around $74 on theta on the strangle. So I have less investment, have less risk. That's just par for the course. Now, the next thing we got to project, Tim, is we have to project volatility. Okay. I expect volatility to rise back into its historical ranges of volatility. Would you agree or disagree that that is a proper assessment of volatility given this current situation?
We're in a vol build situation. There's no question, which is why Nike's a good candidate for all of this stuff right here, because it's historically shown a very predictable pattern. About this far out from earnings, it starts to build back up.
Okay. So the second thing, therefore, we have to project is what?
Volatility.
So if I project and I hit this little parameter button right here, if I project and if I expect around a 15-point movement in volatility, what happens to the volatility, Tim?
It would obviously lift the entire trade up and show profit on the
trade up, right? So as I expected, so let's say we see a 10% increase. Let's say we don't get to the base level here. Let's just go somewhere in the middle. Mm-hmm. So if we see that volatility come up, even though we lose time decay, we're making money on the volatility. And so when I'm looking at this from a potential straddle strangle perspective, right, both trades are good. If I'm looking at the straddle here, I can make about $282 on a 10% increase in or a 10-point movement in volatility. If I'm looking at the strangle here, I'm getting about the same type of profit here, Tim.
I like it. You know, the thing about it,
I think the strangle is the better trade here.
I probably like the straddle better. I think you could, Yeah, they're both good because the theta decay relative to the cost. I mean, if you were looking at apples and apples, obviously you have a little bit higher theta. You get more pure movement from a straddle. So in case you
Absolutely.
catch a directional move, um, I like the fact that it's pinned right to 82 and a half. And I've played Nike straddles in the past. Sometimes, and it's not like this is the plan on a straddle, but sometimes the directional movement actually can be the thing that will benefit and create the
No,
profit.
well, this in this trade here, this straddle, the reason I like the trade is number one, because of the increase in volatility expectation, it's going to at a minimum offset the theta decay, correct?
It should outpace it if it does what it's
It should
supposed to do,
outpace it,
which is the
but
expectation.
sometimes it doesn't. It's not an exact science. So when you're looking at this risk graph, you're like, oh man, I get 268 just if volatility goes up, and I'm only going to lose 78 to $100 if volatility doesn't. That's a good reward to risk ratio, but it's not 1-to-1. It doesn't work like an exact science, but that is the projection. But so let's just say at a minimum that the theta decay is offset and mitigated by the volatility increase. At that point, Tim, you basically got a bi-directional trade that you don't have to worry about theta on, which means delta is positive either if it goes up or down. I love the trade.
Here's the thing I'll tell everybody out there. Volatility trading is an important part of what we do. And in fact, Matt, I was doing some volatility kind of planning here today for my option report, and I had pre-earnings trades, through earnings trades and post-earnings trades. So this would fit into a category we call a pre-earnings trade, which is the volatility build up into the earnings report and trying to capture that part of the movement. I love the analysis, and I actually like doing these for the September ones. I don't know what it is about September, December, March, and June. Those particular ones, they're very consistent volatility builds is what I've found. A lot of stocks are, there's no doubt about it, but Nike's on my list. I like it.
Well, you're just following the quarterly impact, right? I mean, you're talking about March coming up in front of the April, first quarter reportings. You're talking about June coming up before July first quarter earnings. You're talking about August coming up before September and October earnings. So you're talking about that 6 weeks before the natural earnings seasons. These are opportunities across the board, not just Nike. Nike's a good one right now because it's one of the first big companies to report earnings every single quarter. But this is something that I feel like the halftime crew and the tackle team, they can go out there, and if they've never done it, go out there and practice it.
Yeah, I agree with that. The SPX here, as we close the halftime report, we got 2 hours in the day. We're at 28.72. If it closed here, Matt, it would not be an all-time high at the close, but we are right there on the precipice. What do you expect?
Oh, it wants it though.
It does want it.
It does want it. Well, again, the S&P will close above, and everybody's going to say it's an all-time high, and I'll say nope. The futures was at 28.78.
I like it.
Be technically correct here.
All right. Over the weekend, we got a lot going on. Go check out the reports over at Tackle Trading.
Hey guys, real quick, Tim, if you like the analysis on Nike, the straddle, the deep breakdown we did on the straddle strangle on Nike, give us a like and share.
I like it. Okay. What you got planned this weekend, Matt? Working, hanging, working. It's like that pinky in the brain. We're planning on taking over the world, right, Matt?
Well, yeah. I mean, it's amazing now that I'm semi-retired. I work harder now than I ever have.
That's exactly the way it goes.
I don't know how that works, but
well, because when you get pulled in a home, now you've got home projects, you've got kid stuff, you've got a million.
I'm not even talking about that. I'm talking about
right. Yeah. Well, for sure. And that's the beautiful thing about being in charge of your own time, because you can spend it on what you want to spend it on, creative projects, writing, recording podcasts, whatever it is, building our company here. There's no doubt I'm excited about it. I love what we have a chance to do to engage you guys on a daily basis. One quick reminder, we do have that webinar coming up on 9/5. I put the link in the chat. If you have not signed up for it yet, please do.
Hey guys, it is limited seating, and we have tremendous demand for this. So if this is something you want to be a part of, make sure you do it sooner than later.
Yep. All right. Okay, we're done for the halftime report here.
The halftime crew, we're announcing this for you guys before we even let most people know about it.
That's true.
We got an opportunity.
That's right. We're giving you guys the word first on this for sure. All right. Very good job this weekend, Matt. We will see you guys on Monday at the same time, same station here on YouTube. Like and subscribe to our channel if you have not, and get in the game.
We're out. Thanks, guys. Have an absolute great week.